Hello, class, and welcome to our 14th lecture series on financial accounting or principles of accounting. And I'm your instructor, Jamal Haider. Okay, to begin with, we are starting the second phase uh, of our, or you can say the right hand side of the balance sheet. We have covered the assets. We know that the equation is assets is equal to liabilities plus owner's equity, right? In our previous lecture, we talked about the current liabilities, right? Current liabilities. And now we will talk about the long-term liabilities, right? And our next lecture is going to be how we account for owner's equity. We talked about over there, right? So our today's agenda is we'll talk about the long-term liability. So long-term liabilities are bonds payable, notes payable, right? So notes payable can be a short-term liability, current liability, if notes payable is issued for less than a period of less than 1 year. If the notes payable is issued for more than 1 year, then we can say that it is a long-term liability. Then it is written under the liability side and under long-term liability. So let's just talk about the bonds. What is bonds, right? So I'm sure you already know, you already have some kind of like discussion in the introduction to business. So just gonna go through here. A bond is a debt of issuing company. So a bond, basically a certificate like shares, it is issued by the company to the public so that the public can give money to the company as a loan, right? So there are different kind of motives behind that. For example, if company is very good, very credible, and if it goes to the bank and bank says, look, you are a good company, we know that, but market interest rate is right now at 12%. We are giving you loan on 12%, right? And in the market, people are getting saving rates, for example, 8%. When people go to the bank, they save their money and the bank is giving them 8%. But if the company goes to the bank and says, I need money as a loan, the bank says, I'm going to give you 12% interest rate and I'm going to give you the money. So if the company is very good, credible, so company issued certificates called bonds to the public and saying, look, if you give me loan, I'm going to give you 10% interest rate. So that is very lucrative option for the people, for the public. If they save their money with the bank, they will get 8%. And if they save or loan their money to the company is going to give them 10%, right? Or sometimes bank refuses to honor loan of any company because the loan is so huge. For example, the loan is, let me clear this mess. For example, the loan is 5% of total bank loanable asset. Sorry about my writing. Loanable assets. So if bank give loan and that loan is 5%, which is a huge. What if that company is bankrupt after that? So 5% of the total loan of the company is going to be defaulted. So banks are very cautious about that. What if it is 10%? And bank says, look, we cannot give you this much loan. You are asking 4 to 6 billion or $10 billion loan. We cannot, as a single bank, this risk is too huge because this money doesn't belong to us. This money belongs to the public. What if public demand our money back, or there's a run on the bank and we don't have that cash? How we are going to give them, right? Because on the computer network, these are just numbers. When you go to ATM, then real deal starts because they will know that how much actual hard cash is going out from the bank. So 10% of the total loanable asset for the bank is huge. So then company goes to the public for asking loan. Another motive is, what if company's reputation is not very good and banks say that, look, we will say that we, our agenda or our charter says that we are only eligible to grant loans to at least B rating company, and right now your rating is B negative or you are C plus. So you are not eligible to apply loan from us, or your company is your future company future is oblique or confusing, your credibility is low, we cannot give you loan. Then company has no other options rather to go to public. In that case, company will give them huge interest rate because it's already risky, banks already refuse them. So company give greed to the public, okay, if you are going to give us loan, we will gonna give you 15% interest rate, right? So bond certificate, what is bond certificate? It's like a certificate, it's like a a paper form. Right now, due to the advancement of IT sector, information technology, this is now available on online as well. And on that certificates, company name is given, its face value, maturity value, par value is given, right? Face value, what is written on the face? For example, if you hold a 100 yuan bill, it is written 100 yuan. So can you go to the shopkeeper and give 100 yuan and say that, look, I'm giving you this 100 yuan and you give me 1,000 yuan back? No, he will never give you. Why? Because its face value is 100. Maturity value, how much this bond will give you your money back after the maturity value, which means after some time, date, how much it will give you back. So normally maturity value, or most of the time, maturity value and face value are the same. So after 5 years or 3 years of this bond maturity, company is going to give you 1,000 back, right? Par value, what is the we will talk about par value, premium value later when we explore this one. So I'm going to tell you later on these slides that what is par value means. So par value, maturity value, and face value are the same, right? Maturity date gonna be given or written on that certificate. Interest rate is going to be given as it. For example, this bond says, okay, one bond is equal to $1,000 and it's going to give you 9% interest. So remember, that interest is called coupon rate, right? Coupon rate. And remember, normally, or it's a world practice, normally the interest is given semi-annually or semi-annually, which means twice a year. So it means 4.5 is percent gonna be given to you in first 6 months, and next 4.5% is going to be given to you from June to December, right? Interest payment dates are also going to be given to you. For example, here we will say that, okay, June 30. When you purchase that, you also tell your account details, so it's going to be transferred directly to your account, right? So there are types of bonds: term bonds, secure bonds, serial bond, unsecured bond. So terms bond, in which there are some kind of terms and conditions, right? Secured bond, who is those bonds who are backed by some kind of security. For example, the company say that, okay, we are issuing a total loan of $10 million, and what you have to do, give us the loan. And they issue certificates of, normally the bonds are issued with a face value of 1,000. Okay, so how many bonds are going to be issued. So if you divide this by 1,000, answer going to be 10,000 certificates are issued by the company. Okay, and those who are lending money, they demand security. The company says that this loan is backed by company building. If company is unable to pay, so you are allowed to go to the court and ask for liquidation, and this building is going to be sold and you will be given your money back, right? Serial bond, serial bond, like there is some kind of series behind that, in which they say that, okay, uh, we are going to give you interest plus 10% interest plus your principal back. So in that one, there is going to be, if you receive semi annually payments, you will receive interest plus some portion of your principal back. Unsecured loans, which are risky, and in which the company says that, look, we are issuing $10 million loan, and one bond is going to be worth of $1,000, and there are going to be 10,000 bonds are going to be issued in the market, and these are unsecured. It means it is not backed by any guarantee, any collateral, right? Normally, company do not tell to the public that what it will do with this $10 million, but they ask and they give you higher interest because these are more risky. Information is like not completely available, so asymmetric information is there. So the company is going to give you higher interest rate as well, right? Or these are also subordinated loans. For example, building is worth of $20 million, right? But company issued $10 million and says building is collateral, and then company issues new shares of $10 million against that building, right? So what do we mean by subordinated loans? So first, the first issued bonds is going to be paid, and for example, the building is sold for 19 million. So first, the secured loan is going to be paid. So what $10 million is going to be paid for secured loans, and then $9 million is going to be paid for second subordinated bonds. It means the second subordinate bond will have some kind of risk for not getting full amount paid back, right? So that's why unsecured loans or subordinated loans, they are a little bit riskier. So these are just the definition. So let's just talk about, now we are deep, diving deep into the calculation part and the accounting stuff. So first, we understand what do we mean by bonds prices. Okay, so up till now, what we have learned, okay, there is a bond is certificate on which its face value is going to be written. When face value is going to be written, it means and also there is a maturity date. For example, this is from January 1st, 2021 to December 31st, 2024, right? For 3 years. And they're going to be 10% interest semi-annually, right? So the interest rate written on the bond is called, we just talk about coupon, right? So there is another interest rate, that is the market rate or bank rate.